Hello, everyone, and welcome to today's webinar. Today's virtual conference is on the economic outlook for emerging markets. My name is Emily Slater, and I'm the Deputy Director here at the Bretton Woods Committee. I would like to thank you all for joining us today, and especially our esteemed speakers, who we will hear from shortly. This program is part of our Regional Spotlight Series and also this year's special Bretton Woods at 75 initiative, a global dialogue to honor 75 years of economic progress and to revitalize the spirit of Bretton Woods now and for the future. Today, we will examine emerging market risks and opportunities and discuss the IMF's role in ensuring financial stability. Before we get started, I would like to go over a few items so you know how to participate in today's webinar. You should see the attendee control panel in the upper right-hand corner of your screen. You can collapse and expand the control panel by clicking on the orange arrow icon. By default, you have joined using your computer's speaker system. If you are having audio connection or sound quality issues, or would prefer to join over the telephone, just select phone call in the audio pane and the dial-in information will be displayed. Participants will have an opportunity to ask questions during the Q&A portion toward the end of the discussion. If you have a question, please type them into the questions pane of the control panel. You may send in your questions at any time. We will collect these and call on individuals, so you may pose your question directly to the speakers. You will be prompted when it is your turn to ask a question. I would now like to briefly introduce our speakers. We have with us today Dr. Geeta Gopinath, who was recently joined the IMF as the Economic Counselor and Director of the Research Department. She is on leave from Harvard University's Economics Department, where she is the John Swanstra Professor of International Studies and Economics. We also have Dr. Catherine Mann, the Global Chief Economist at Citi. Prior to joining Citi, she was Chief Economist at the OECD. Dr. Mann is also a contributing compendium author to our Bretton Woods at 75 initiative. Meg Lunsiger will be moderating today's discussion. She is the Public Policy Fellow at the Wilson Center and is one of our own Bretton Woods committee members. She previously served as the U.S. Executive Director to the IMF. So thank you all very much for joining us today. And I'd also like to point out how appropriate it is that we have an all-female speaker lineup on International Women's Day today. So Meg, with that, I'll turn it over to you to kick off today's discussion.
Thank you very much, Emily, and I want to thank our two guests for joining me today for this discussion because I'm sure you'll have a number of insights. And I thought it would be useful before we turn specifically to emerging markets just to set the global context. I know at the IMF you're working on the global outlook that you'll be presenting at the spring meetings next month. And Catherine, of course, this is something that you're looking at every day, reassessing. And we've seen some dramatic, changes and developments in policies, and it would be very helpful to get a sense of how that sets the overall tone for the global economy, given that we've seen some markdowns in global growth rates that are forecast for 2019, and we've seen some recent developments, for instance, the dramatic actions that the ECB announced yesterday, their concerns about Europe, others, the U.S. slowing down a bit but still growing. China slowing, and the rest of the world we're just a little bit uncertain about how they're going to manage. So could you give us a sense of how you see the overall outlook, and keep in mind what that impact is going to be on emerging markets when we turn to that discussion? So Geeta, I'd very much like you to present sort of where your thinking is these days. You've been at the IMF just a few months, but I'm sure you've gotten that sense of the overall what's going on in the global economy and how important the IMF is to that. Geeta?
Thank you, Meg. Happy to do that. And just to start off with Happy International Women's Day. So it's great. So quickly on the outlook, as you know, we are working on it again for the April WEO presentation. But when we presented this in January, what we had flagged was that the global economy was slowing and somewhat faster than we had expected in October 2018. So we had revised down growth for 2019 by about 2 percentage points, about 3.5%, and it's going and 3.6% for 2020. So what's changed since our January WEO update? What we are seeing is that the second half of 2018 was a little worse than we had estimated, and that negative impact has spilled over into the early part of 2019. So that's certainly weighing on growth for 2019. Some of the source of the weakness remains similar to what it was the last time around, which is the euro area. So in terms of the parts of the world that are slowing kind of more faster than we thought, a lot of it is coming from the euro area, and specifically from two economies. The one is Germany. So Germany's growth has been was revised downwards in January, and that came from a combination of factors. One was the new rules on fuel emissions that had a negative impact on auto production. But then there's more generally been a weakening in domestic demand in Germany, and in export demand, given that Germany is certainly one of the big exporters to China. In the case of Italy, the weakening has come from higher sovereign borrowing costs, the link to the banking sector, so generally from some financial tightening in Italy. Toward the end with France, we had the political issues with the yellow vests, and so that has weighed a little bit negatively. But the euro area is certainly the area that is weakening and is weighing down on growth. If you look at emerging markets, of course, the major one we think of always is China. China is slowing, but that's part of the design, as we expect China to move away from infrastructure investment-driven, credit boom-driven, export-driven growth to more domestic consumption-driven growth, which is what we would expect given the stage of development of the country. We expect growth to continue to slow. So we had projected for 2019 and 2020 about 6.2 percentage point growth for China. So we expect China to grow. The big question, of course, is whether this growth will be smooth, will be gradual, or will it be steeper than we think. In terms of what's been slowing growth for China for 2018, the major factor has been mostly domestic, which is it's come from financial tightening, that's come from the deleveraging, that was associated with this governmental push to regulate the shadow banking sector to prevent excess credit growth. So that was really what weighed on growth in China. In the matter of trade, trade held up quite well through most of 2018. It weakened in November of 2018, and then there was a contraction in December. And we're seeing again some weakness in the early months of this year. But that's where. But again, it's not so much trade as much as it's been domestic financial tightening that's been the driver. In terms of other major emerging markets, there's Brazil and Mexico. With the case of Brazil, given that it has still a lot of cyclical, the output gap is still negative, and that we expect to see a cyclical improvement in growth. The prospects look fairly positive. Now, of course, the policies have to be put in place, and there's always this concern with Brazil in terms of fiscal expenditure that they will have to deal with. In the case of Mexico, on the other hand, Mexico goes a bit in the other direction from Brazil, where our estimates were for Mexico going forward were on the downside, and that was because it had already done much of the cyclical correction, and the change in the political scenario there in Mexico was also weighing somewhat negatively on growth. India is the fastest growing large economy in the world, so that is one of the bright spots in terms of our projections. But just very quickly, in terms of risks that we worry about going forward, the first is on the trade conflict. Now, it is the case indeed that by the end of March, it's likely that there will be an agreement between the U.S. and China, We don't know the specifics of what that agreement would look like, but that certainly looks a little better than 2018 did. But I don't think that takes trade tensions off the table. There are real concerns about what's going to happen with the trade discussions going on between the U.S. and EU, and especially the auto sector. And that is a major concern, because if you think of global supply chains, that is one of the biggest global supply chains in the world. So any disruption to the auto sector using tariffs would be in our opinion, even more costly for the world economy than the current ongoing U.S.-China trade tensions. That's one. The second is about financial conditions and whether there can be a sudden tightening of financial conditions in global markets. Now, what we have to recognize is that in response to all the weaknesses that we saw in 2018, especially towards the end, there's been kind of monetary authorities around the world have all become far more accommodative with monetary policy. So if you take the U.S. Fed, the ECB, the Bank of Japan, the People's Bank of China, the Reserve Bank of India, all of these are now on more of an expansionary stance. So the Fed has moved towards a wait and kind of a pause, patient approach. Markets have interpreted that as not having any rate increase at all in 2018, and maybe even a possible rate cut. So a lot of the improvement that we saw in financial markets in the beginning of this year is a reflection of this change in the Fed's monetary policy stance. But if it does happen that the markets aren't getting it right, that there's actually communication that comes on later on that says that the Fed might actually raise interest rates, I think that there could be a serious market correction over there. But more generally, the reason we worry about financial tightening is because we are living in a world with very high levels of private and public sector debt, and that's an issue. The other last, and I'm going to stop with that, is the one is China, which is that while our estimates are for China to slow down, but at a gradual rate, there is always a possibility that the decline could be worse and faster than we think. And there are real risks to that. There is a risk to property prices. Property markets in China still look overheated, so that is one source of risk. The trade tensions, the trade conflicts are another source of risk. Exchange rates and capital flow volatility is another source of risk. Now, the Chinese government has put a lot of stimulus in place, both on the monetary policy side and on fiscal policy. So our expectation is that this stimulus, which will become even more, the impact of which will be more seen towards the second half of 2019, should help outcomes in China. But that remains an important risk. And so with that, I will stop.
Thank you very much, Geeta. So, Catherine, turning to you, as I listen to Geeta and we all look at the recent developments, I get a little worried about how the overall global economy is going to be doing and how a lot of countries are going to be able to move forward. So do you see any bright spots in this, or are we really at risk? And if we see that the risks really are building and we should be much more concerned, what's the policy space that countries have? I mean, Geeta just mentioned how the large central banks have all become more accommodative. Where are we on fiscal policy, and how much policy space do we see in the rest of the world?
So let me just give a little bit of an overview of where we are on the global economic performance. It's by and large, I agree with the outline that Pete has given, but there are a couple of nuances that I think that's relevant to think about. So the framework that we use to evaluate how things are going is we look at domestic resilience, and that is principally looking at the situation in labor markets and both the tightness in the labor market, the wage growth in the labor markets, but also the extent to which tightness in labor markets is the foundation for technology-embodied investment to deal with the fact that you perhaps can't hire the workers that you want to hire. So you either have technology capital to substitute for the labor you can't hire to complement the labor that you can hire. And so that's one aspect, one pillar that we look at. The second pillar that we look at is the external headwinds, which have been, of course, intensifying over the course of the year. And the third pillar is on financial conditions. So we look at these three pillars and we evaluate these pillars based on how the data are changing, as well as what the level of the data are. And it's an important difference because there are definitely occasions where the market's interpretation of the deltas, or the market focuses on the deltas, for example, a deterioration in the PMI manufacturing in the United States in December, where it deteriorated from 58 to 54. Now that was viewed by the market as a very serious deceleration of portending a deceleration of the U.S. economy. But in fact, of course, we would normally say a PMI manufacturing at 54 would be terrific because it's well into the expansionary zone. Moreover, in terms of domestic resilience, thinking about advanced economies, but also emerging markets, the share of the consumption basket that is on manufacturing and the share of production that's in manufacturing is actually, pretty small. Consumption basket is 60 to 70% on services. And so when we look at, again, the levels of the deltas of a non-manufacturing PMI, it's well into 57, 58 for most countries, not all, but for most. And so it's very important to evaluate the strength of a domestic economy and the strength of domestic resilience against where we are on the levels of economic performance, not just what the changes are. And I think the financial markets do tend to focus on deltas, not levels. So domestic resilience is strong, really across the board. Germany is a case where we see a lot of problems on both the domestic side as well as the external. So turning now to external headwinds, which, as I say, have been the external headwinds have really been intensifying over the course of the year. And that's manifested relatively more in Europe. It's a more open economy, not particularly a big issue for the US. It's basically a closed economy focused on services. And so the domestic resilient balance between domestic versus external is advantageous for the US, and we see that in the data, less advantageous for Europe, and we see that in the data. Turning now to, and I want to say a few more things about the external headwinds, but turning now to the third pillar on financial conditions. The financial conditions, the turbulence that was associated with financial conditions in December was entirely in the equity markets. The equity markets, and of course, all of that has been unwound, and subsequently, financial conditions have become even more accommodative as institutions, central banks, and so forth, as Gita mentioned, have moved towards an easing stance, either explicitly in the case of the ECB or moving underneath the umbrella of the pause at the Federal Reserve. So financial conditions accommodative. So let's turn now to a little bit more on the trade angle of things and develop a little bit more sort of a forward-looking sense of what might happen if we get to a deal between the U.S. and China. This is a case where the market has priced in already probably whatever it is that whatever deal is going to be made. So we worry about there being both a financial market reaction, you buy on the rumor and you sell on the news, which is kind of a standard lingo. But there are other aspects of the way the deal might actually play out, which means that selling on the news is exactly what you should be doing. And the reason why is, let's think about the prospects for the global economy. If we take the successful bilateral US-China deal. What does that mean, success? Well, it probably means that the bilateral, if we look at the contours of what success means, it will mean that China will buy more stuff from the United States and the US will have more market access in China. That's kind of the bilateral objective. Maybe it'll be some technology products, hard to say, but China buying stuff from the US in order to reduce the size of the bilateral imbalance, that implies that they're not going to be buying stuff from somebody else. And so the spillover effects of a successful, and I put it in quotes, successful bilateral deal with the US is not really a good deal for other countries. And so that's even abstracting from what Gita mentioned, which was the increased tensions with the EU with regard to autos. We also, of course, don't yet have a signed agreement on USMCA, the NAFTA 2. But all of these approaches that the U.S. administration are taking with regard to the trade arena, if we look at them in a collective sense, they are divide and conquer. In other words, they are all bilateral. Start with one country, then go and then make a deal with the country on a specific product set. So it's bilateral. It is product specific. And so it ends up fragmenting the multilateral trading system along both product and regional or country-specific lines. So from the standpoint of what we think about where the gains from trade come from, which is having a broad set of markets to sell to, having a broad set of markets to buy from in order to enhance variety, get lower prices, being able to get economies of scale. All of that is being eroded sort of deal by deal. And so when we look forward for prospects for global integration, they don't look good. So what does this mean, from the standpoint of global growth prospects and global inflation prospects, by the way? So global growth prospects are really undermined by this succession or prospects for successive bilateral, quote, quote, successful bilateral deals. And I think that does mean that for those countries that are not directly going to potentially benefit on a product by product basis, meaning most of the emerging markets are going to be left out. And that will have implications for their global growth. We've done an exercise of two different scenarios for global trade. One would be sort of returning to the multilateral trading system, so taking off all the tariffs, removing the threats of tariffs. And then we've done another scenario, which is one where we have very substantial deterioration, these successive bilateral trade deals and what that might mean. And so for the emerging markets, the difference in growth rate projections for 2019, the difference is 1.7 percentage points. That's a swing from the most negative, which we have 3.9 for emerging markets relative to our baseline of 4.4, as compared to a return to a more globally integrated system, which would yield a 5.6% growth rate for emerging markets. So this is a pretty big swing for emerging markets. And so the consequences of the trade environment, broadly speaking, has really significant implications for emerging markets. We can go down and talk more about different countries and how they might be affected by a bilateral deal between the US and China through spillovers through the supply chain. There are winners and losers in terms of which countries. Some relative winners are Vietnam, Malaysia, and Thailand, and some relative losers, for example, are Korea. So that's where I want to leave on the trade side. And then the last point on financial turbulence, I come back to basically the same point that Gita made, is the markets right now are pricing in rate cuts for the Federal Reserve. So their assumption is that the worst of the global economic outcome is likely to be observed, and that the Fed will have to cut. That's not what the median dot has to say. That's not even what the press conference in January had to say. So I think that there's potential for financial conditions, even though they're on pause right now. They're probably not going to be as accommodative throughout the course of the year unless this deterioration in the trade environment really is the one that we observe. So in the end, if I had to find between our three pillars, domestic resilience, that's there, it's strong. Headwinds are increasing on the external side. Financial conditions are on pause right now, but there is downside risk because of trade and because of financial turbulence.
Thank you, Catherine. That really is food for thought, and that is something that I've been thinking about too in terms of, just simply looking at commodities, the countries that were able to jump in and substitute for U.S. exports to China that they cut off. How much of a swing is it going to be? Because I certainly expect agricultural products to be quite a large part of any deal. But Geeta, let me come back to you just with a follow-up on all that in terms of how do you see emerging markets being positioned to handle some of these risks that you both have discussed, whether it's trade, whether it's some of the domestic origin of some of the problems that both of you have mentioned, financial conditions, even fickle capital flows that we can see, move in and out depending on, as Catherine has just been pointing to, financial market news as opposed to looking at longer run trends. So can you give us a sense of how the IMF views the policy space in emerging markets, and if there are any particular countries that, are a good illustration, please go ahead. But otherwise, more generally, are they prepared? Are they going to be able to handle what some of these fluctuations might bring this year?
Certainly. So let me just break this up into a few points, which is, firstly, what do we think will be the impact? And then second, about what policy space exists to deal with the impact. So on the first point, I completely agree with Kathy, which is that while it is still unclear what nature, what form the trade agreement will take, if any, between the U.S. and China toward the end of this month, there is certainly a sense that there would be trade diversion from other emerging markets towards China buying more goods from the U.S. Now, of course, if the trade deal takes the form of China reducing tariffs, U.S.-specific tariffs, then that obviously has a positive effect globally. But if it takes the form of just China having to buy a fixed amount, $600 billion worth of goods from the U.S. to close the bilateral deficit, then we can think of them literally just redirecting their imports from out of other parts of the world towards the U.S. And so, so there are countries, some, Korea was an example of a country that could be negatively impacted by this kind of policy. Then you have a country like Mongolia that sells a lot of copper to China, and if China were to turn around and buy copper from the U.S., then that would be an 85% drop in their exports. So we expect to see this, and I think there's absolute nervousness in the region about whether this is what the trade deal is going to generate. So there are these negative spillovers there. For Latin America, there could actually be positive impacts of some of these policies. So we did see that with the imposition of tariffs on goods coming from China, we did see categories of goods there where it looked literally that the imports were being replaced from China to Mexico. So the goods were coming from Mexico as opposed to coming from China. And so, countries that are in geographical proximity to the U.S. that are not hit by these tariffs are certainly benefiting some from it. But let's look at Latin America. If you look at Latin America, I think for the big economies in the region, the problems are domestic. So again, with Brazil, I think there is a serious issue with their fiscal space, with their fiscal expenditures that they have to incur in pensions, and these are going to be very near-term costs. Mexico, question is what's going to happen to policies in Mexico with the new government in place. So these are real these are real concerns. Now, so I would say that Latin America is quite fragile. Of course, you have Venezuela where things are really, really bad. Mexico, Brazil, Ecuador, I mean, all of these countries are not exactly in a healthy place at this point. So what that means is that any headwind, in any kind of negative shocks that come from the rest of the world, from the global economy, is going to make things even harder and very volatile in that region. So for Latin America, I think a big important fact is going to be what happens to financial market conditions. So if there is a sudden tightening of financial market conditions, that could have an important impact on these economies. Again, Argentina is another country that is not in great shape. And so going forward, in terms of policy space, again, it varies across countries. Our view for China is that China has the space on the fiscal side and the monetary side, and given how China has so many more policy levers than most governments in the world do to control their economy, that they should be able to weather these global headwinds. But of course, in countries like in Brazil and in Argentina and Mexico, the fiscal space is really not there. So the U.S. Fed deciding to take a pause has been helpful, I would say, for emerging markets in the sense that we've seen a resumption of capital flows to these markets. But in the event that there is a sudden tightening, things can change pretty quickly. And by the way, I should also mention that since the name didn't come up, I think we should mention that while Brexit remains a concern going forward, though it looks like the probability of no deal Brexit has gone down some, I don't think that's off the table. And in any case, if the can is kicked down the road, everything has to be resolved in 3 months. So the question is what's going to change between now and then.
Yeah, thank you, Geeta. So, Kathy, coming back to you, how do you see policy space for countries being able to handle these sorts of fluctuations? And then maybe what we can do is start also to move into a discussion of concerns about debt, since we've touched on financial conditions at several points.
So in terms of policy space, I'm a little bit more positive, actually, about policy space. And we evaluated both fiscal and monetary policy stance in our December prospects for 2019. So it was written in December 18 and looking forward. And then we took our projections from our countries for what they thought was going to be fiscal and monetary policy stance going into 2019. So this was before the turbulence. This was before the trade headwinds had accentuated to the degree that they have up to now. So people were looking for some deceleration into 2019. So it wasn't as if it was, going to be a great 2019, but it wasn't as clouded as it currently is. And then we reevaluated what our country analysts thought was going to be fiscal and monetary policy space just a few weeks ago. So this was, as trade tensions have had and turbulence have increased, as China has slowed down even more, as other economies have slowed down, including in Europe. And so we reevaluated what was happening with fiscal and monetary policy stance. And what we have found is that quite a few of the advanced economies have announced fiscal stimulus or less austerity, depending on who you are. And so there has been a decided move towards a more accommodated fiscal positions, which would be consistent with trying to offset these external headwinds. There's also been, again, this was even before the ECB policy move yesterday, that there's been more of generalized easing on the monetary side as well. So if we think about policymakers, they have responded in the way that we would think appropriate to a more clouded economic condition. So that's good news, I would say. In general, that's a good news story, especially in Europe, where we know that if all of European economies collectively would use fiscal space, then each one of the countries does not have to use as much because the spillovers become spillbacks to their economies. So when we think about Europe acting as a collective fiscal entity, which they do not have the institutional arrangements to do that, but nevertheless they can mimic those institutional arrangements. If each one of them does a little bit of action, collectively it has higher multipliers. So taking advantage of that in Europe makes a lot of sense, and it looks like by and large they are taking that direction. Now in emerging markets, the monetary policy stance has eased somewhat, and that is, I think it's indicative that emerging market central banks feel more confident that they have in place some credibility. I think they've built up a lot of credibility over the last few years, and as a consequence, they have more resilience in the face of financial turbulence. They don't have to immediately react by tightening in order to either offset concerns about depreciation of their currencies, pass through to inflation, and they also don't have to immediately tighten in the face of capital flows. I think the central banks have more credibility. They've, especially in Latin America, they've become they've anchored their expectations much more effectively. So what that means going forward is that they have more room to maneuver, or maybe not move so much. In that sense, they don't have to react so strongly to either capital market adjustments or to exchange rate moves. Say in the United States, probably there's going to be more appreciation in the U.S. given what the ECB did. It will probably last longer because the growth, unless the Europe growth differentials close, which there's some. The most recent data that came in today was more positive for Europe as a whole than most people thought it was going to be. So, but nevertheless, the growth differentials probably still are going to favor the U.S. The interest rate differentials still are going to favor the U.S. So that puts into place an appreciation of the dollar. And emerging markets in the past, in the olden days, in taper tantrum type period, would have had to react very strongly against that, which would have been negative for their own economies, would have exacerbated the downdrafts that they're getting from trade. But I think that, as I say, the central banks have more credibility, collectively have more credibility, individually some do more than others, and will not have to react to tighten in response. And that gives more, everything else being equal, more positive bias for emerging markets.
Okay, well, thank you, Kathy. That's really useful, because one thing that I've struggled with is, we've seen a bit of a reflow of some capital flows to emerging markets just recently after the outflows last year. And so the question is, are countries using it productively if it's adding to debt, if it's not all equity, or if it's very, volatile? Are the countries prepared to handle it? Are they using it productively? Are they adding to reserves? Are they letting their currency appreciate a bit? Some of them, after significant depreciation, I think would like to see a bit of appreciation. But is it a worry that the capital flows are going to continue to be volatile this year, in large part, depending on what's going on in advanced economies and monetary policies, as you've both discussed, but also what's going on in their own countries and what risk of contagion might be? Gita, you mentioned Venezuela. That's a case on its own, but just given some of the jitters in other emerging markets, whether it's Turkey, the lira keeps dropping, Argentina continues to have problems, admittedly, maybe related to the elections, but how worried are we, or should we be about, or is it not a problem in terms of handling capital inflows, outflows, and what one country really taking a dive, having a serious problem, would that be an issue of contagion for other countries? And to our listeners, while Gita and Catherine are answering that, please let Emily know if you have any questions, and we'll turn to questions in a few minutes. Thank you. Gita?
So firstly, I want to agree with what Kathy said, which was that emerging markets are certainly less sensitive to interest rate movements in the U.S. and then the implications of that for their currencies and therefore for their inflation. So they certainly have built up more reputation. They've had more reserves, which has made them more resilient. And you saw that in 2018. If you look at when the Fed was tightening, there were some countries were very strongly negatively impacted, and others weren't, and it was tied to their fundamentals. So it was the countries that had bigger current account deficits that were the ones that actually had the larger increase in weakening of their currency and bigger problems for their economy. So I agree with that. Now, I think it's not a uniform story, though. There are emerging markets where I think things are going to be more difficult. And I do think, if I think of Argentina and I think of Brazil, I think that that their economies can be quite sensitive to big changes in financial conditions. I think in the case of China, I do think that they have the space to do more on the monetary and the fiscal side. So the bottom line is that it does vary. Even India, which has a pretty strong central bank, has had to in 2018 had to deal with a stronger rupee and the impact of that on inflation and the other part. Now, there's one aspect for a lot of countries like India, which seems less of a threat going forward, is where the commodity prices might go up suddenly, right? And so that was for several. There are emerging markets who are big buyers of commodities, and India being an example. And the big increase in commodity prices was a negative factor. And that, at least, it doesn't look like that in the near term is going to happen anytime soon. Of course, but on the flip side, big commodity exporters are having a drag on their growth from it. Now, to your question of capital flows and the sensitivity to it, it is certainly the case that there was some reversal in capital flows in 2018, but just to keep things in perspective, nothing in 2018 looked anywhere remotely close to what happened during the financial crisis, right? So we're talking about movements that look more like 2015, 2013 during the taper tantrum, less to do with any major shift. Now we're seeing capital going back into those economies, and just if you look at the breakdown in terms of where capital is resumed going into, the main country has been China. So China ETFs, China mutual funds, that's where you're seeing the money going in. It's going into some other emerging markets too, but we're not seeing like a huge, big boom or resumption of flows or what. So things are far. The way I would describe it, things look a lot less volatile than it did in 2 decades ago, when movements of this kind would generate big swings. So it's certainly the case that EMs as a whole, in terms of building up policy strength, have signaled to the markets that they better behave. And I think that there's less contagion that we used to see in the past, and less of knee-jerk reaction that we used to see in the past in markets.
Well, thank you, Geeta. So this brings to mind, if it's the bulk of the capital flow is going to China, and the concerns both of you have raised, it really sends a message to a lot of the emerging markets, the other emerging markets, that they do have to really look out for themselves. They can't be reliant on continuing stable flows when there's a lot of competition for them out there. And of course, given the trade volatility that you've both raised concerns about. And the other thing that both of you have touched on to some extent is with more flexible exchange rates in a number of countries, they're better able to let their economies adjust to these changes. But I do want to open up to questions in a moment, but I just want to get both of your views, and I'll start with you then, Catherine, on debt concerns that have been raised in terms of a number of emerging markets. Now, we've seen debt levels go up, and countries so far, for the most part, appear able to handle it and able to service it, of course, interest rates remain fairly low, so there's not that tension on it. And they've been able to roll over and undertake new debt. Many analysts have also pointed to higher corporate debt or even household debt in a number of countries, including emerging markets. So Kathy, do you think this is a concern? Are countries keeping an eye on this and keeping their regulatory space lined up and looking at this so they can evaluate what's going on and take appropriate domestic measures?
So we've done a very detailed analysis of debt buildup by across countries, across different types of debt. So it's the obligor being the sovereign, being the household, being the financial corporation, being the non-financial corporation. And the bottom line of that very detailed analysis is that there isn't a bottom line. There isn't like one thing that you can say. It's very much a heterogeneous picture that for individual analysts and individual asset managers, it's what portfolio do you want to hold, and you can de-risk it by getting rid of certain corporate debt in certain countries. You can add in some return by buying financials in another country. So there isn't one common point of contagion, I guess. I mean, if we go back to the financial crisis, we're still kind of sifting through all the wreckage there when we do our data analysis and do our research. But pretty simply, I think that most people would say it was lending standards, asset-backed securities, lack of transparency, leverage, concentrated in a set of financial instruments, mortgage-backed securities. And so once that went, then there was that was the stone that got dropped into the pond. It was a big pond, it had big waves, and it became a global financial crisis that hit many countries and took down a lot of other asset classes along the way. So the assessment of where we are now, when we try to again look at this now, is we don't see that same kind of potential source of contagion. Not that there isn't debt buildup, but that and not that there aren't lax lending standards. We can definitely see that in certain asset classes. But what is different is the networked nature of the and the linkages across these different assets and across the different obligors, both country as well as private sector. So does that mean that there aren't going to be problems? No, there definitely will be problems. There will definitely be some households in some countries may be at risk coming from overall household debt. Corporate accidents quite possible in some other countries. Sovereign debt perhaps not being a good investment in third countries, but it does not appear that the interrelationships have the same strength and spillovers to generate the kind of global financial crisis that we had before. So that's good news, and it also appears that to the extent that it is a regulatory issue, banks are better capitalized. Banks are not going to be the source. It doesn't mean that there won't be accidents elsewhere, other parts of the financial sector.
Yeah, no, thank you, Catherine. That is, I think, a concern sort of across the board, and I know the regulators continue to worry about that. What are they not capturing in terms of their work? But Geeta, how is the IMF looking at debt levels in countries? I mean, as you know, the IMF is mostly fiscal, and it's always been a concern. Every Article 4 the IMF ever does talks about, worries about debt levels, whether it's government debt or corporate debt, and the ability of the country to manage it and to continue to roll it over or to undertake new levels of debt to finance future investments. So how is the IMF looking at debt levels in emerging markets these days?
Right. So we are flagging that debt levels are very high, both on the private sector side and the government. And so, over the last 10 years, there's been a large buildup of debt around the world, which is why we flag financial vulnerabilities as being particularly important, given that we live in this world with high levels of debt. To tie this to what Kathy was saying, I agree with the fact that the nature of the risks have shifted, especially in the U.S., where I think there is with all the stress tests and the regulations that we have, the banks look quite safe. But of course, then there is the problem of what's happening on the corporate debt market and the high levels of leverage there. But just to be clear, the health of banks in the U.S. is not the same thing as the health of banks in Europe. Italy, for instance, there remain concerns about the banking sector. There remain concerns about the high levels of sovereign debt in Italy and the cost of borrowing for Italy. So that remains a factor. Even among the large economies of the world, it is an important factor. Now, to your point about emerging markets, again, let's start with the biggest, is China. China's overall debt is about 250% of GDP. That number always shocks people and thinks that there's an imminent crisis around the corner. But again, it is a country which has a 45% savings rate. There is sufficient financial repression that goes on. There are enough policy levers over there that it remains this case that, like Japan, which also has an incredibly high level of debt to GDP, that maybe this is not going to spell doom very, very, very soon. And of course, the government is doing a lot to try and prevent a further debt buildup. For other EMs, I think the bigger concern is for countries whose external borrowing, and especially sovereign borrowing, remained in a foreign currency, that remained in dollars. So I think there's an interesting comparison to be made between Argentina and Brazil in 2018. Both Argentina and Brazil have borrowed from external markets, with the difference being that Argentina relies almost entirely on dollar borrowing, and Brazil relies a lot on local currency borrowing. And so the effects of exchange rate movements then are far more severe for one country relative to the other. So I think a piece of the policy advice is to just encourage countries to move away from borrowing in dollars. And of course, this is a chicken and egg problem, because when you don't have the reputation of keeping inflation in check, only countries will lend to you in terms of dollars. So there has to be a kind of a coordinated policy response to this. But it's something we flagged in January. It's something we will flag again to your broader question. We think debt is an important concern. But at the same time, we also flag, and this is, I think, a change from the past at the fund, which is that we do want to see the possibility that if the euro area, for instance, were to slow more, that there could be more fiscal role there.
Thank you, Geeta. That was very useful. We're getting close to the end, so I do want to turn it to our audience and take some questions. Emily, can I turn it back to you?
Yeah, thank you, Meg. We do have a few questions from our audience. I'm going to go to Carolyn Campbell. Carolyn, you're unmuted if you want to pose your question to the speakers.
Oh, dear.
Carolyn,
could you identify your organization too, please?
I'd love to. Hello, can you hear me?
Yes.
You can hear me?
Yes.
Oh, great. Hi, yes, I'm with Emerging Capital Partners. We are large equity investors in Africa since 2000. We have investments in over 45 countries. We've made about 65 investments and exited 48 of them. And we have seen an evolution of the markets there to become more sophisticated. When we started investing, obviously budget deficits were very much under control, as were public debt levels. That's changing now. And I wanted to see if any of the remarks that you made about some of the larger economies, you mentioned in India, Brazil, Argentina, and the global trends from a lens that was from their perspective. But if you could perhaps comment on there is some pressure occurring in some of the African markets like Kenya, Nigeria, South Africa, budget deficit wise. They're, scrambling for revenues, tax revenues, trying to get their deficits under control, while also trying to undershore growth in those markets. Or are those not within the perspective you're giving today? Those sorts of second and third tier emerging markets.
Well, let me turn to both our speakers. Geeta, do you want to just touch briefly on the Africa outlook, particularly the large countries that were mentioned?
Sure. So yes, so the African continent, again, the growth is pretty diverse in different parts. Now you have countries that are major commodity oil exporters that are being negatively hit. So when you think of the commodity prices, went up some in 2018, but then have declined and are expected to stay weak. And so for a country like Nigeria or even for South Africa, these are big. These are this is an important headwind to growth, and that then, of course, combined with political tension. So. Our overall outlook is that, of course, the potential for growth remains. And so, if we're going to think in the medium to long term in terms of where is growth going to come from, we continue to expect this part of the world to be, one of the positive prospects, as opposed to the advanced economies where I think in the medium to long term, we're looking at an aging population, lower productivity growth, and therefore just kind of modest growth prospects. So this is a positive part, but for the reasons that you mentioned, which is that with changes in oil prices, with the political tensions, there have been these concerns with with countries here that have led to some weakening in their growth, but we might expect some of this to be transitory. And of course, there are some countries for which we expect a major rebound at some point in the future.
Thank you, Catherine. Do you have anything you'd like to add?
So the points to emphasize is we're actually very bullish on commodities. So to the extent that copper, palladium, iron ore, even oil have a lot of upside potential. Oil could actually have quite a rebound depending on in the second half of the year, depending on what happens to some of the supply side issues. So to the extent that you're a commodity producer, then that's going to be supportive of revenues. But I think that there are a lot of domestic structural issues facing many of these economies that have been perhaps now are becoming much more apparent, and so it's more difficult for a commodity boom or a commodity even stabilized commodity prices to allow a country to weather those structural issues internally. And I think we have to add on top of that some of the concerns about the debt buildup and the value of the building associated with Belt and Road. That has been an important ingredient. Some of those projects are very effective and important ingredients to support growth in countries that are recipients, but in other countries they have been less effective and have been less supportive of growth and tend to just create a debt burden. So some of those countries are in Africa, and that has to be part of the consideration.
Thank you, Emily.
We do have several questions, and in the interest of time, maybe I'll just consolidate and summarize a couple, and you can choose what you would like to respond to. So a few of the questions that are coming in are around how are political risks from elections, how is climate change, and how are technologies such as financial technologies such as blockchain factoring into any of your outlook for emerging markets. So maybe respond to any combination of those, and that'll be our final question.
Geeta, not a short question, but if there's anything there you'd like to pick up on, please go ahead.
I guess the short answer is that we are paying close attention to all of these factors: the political risks, climate, fintech. I mean, all of this is part of the work program at the fund. I mean, just in terms of near-term concerns, I think the political tensions of very, very different kinds across the world or political changes of very different kinds around the world are certainly a matter of concern. In some parts of the world, it's strong nationalism, which is weighing, which is making multilateral growth, multilateral cooperation so much harder these days, as everybody knows, is a major factor, and a big part of the headwinds to growth has arisen from this big increase in nationalism in many parts of the world. The changes in just, in the example, if I were to take of, say, Mexico, in terms of political transitions over there, that is clearly one of the factors that's weighing negatively on growth in terms of policies going forward. And in terms of climate change, so those are the more near-term factors. Climate change is one of the important factors that affect our medium-term outlook. Now, of course, I think one of the things that we're learning is that maybe this is not as distant as we think it is. Some of the revisions to growth for Japan in 2018 came from all of the natural disasters over there that some attribute to climate change. But so this could be even more imminent. But it's in our work program to think about what's going to happen in the medium to long term. And of course, a lot is going to depend upon our policy response to it and how we deal with that problem. Fintech, all of that is a part of our, again, work study. We're trying to understand the impact of that, not just the negative impact, but also the positive impact of that in terms of financial inclusion. But again, just to keeping in mind the fact that an important part of the concerns that we see today in terms of political tensions have to do with labor markets and have to do with job creation and wage growth, and we think very deeply about how these kinds of technological developments ultimately will weigh on this.
Thank you. Catherine, you'll have the last word.
Well, so I mean, the business community is very much focused on climate change issues. It's an important factor when thinking about what you should be having in your portfolio. If you're an insurance company or a reinsurance company, you care about this a lot. If you're a financial institution, you also care about this because these are risk exposures that maybe aren't going to be something we see today, but are going to see it very soon. Because I agree with what Guido said, which is we're seeing the consequences of climate change right now. So it's not like it's sometime off in the future. Blockchain, again, is front and center in terms of affecting the conduct of business and conduct of financial relationships. So those are all, business has that right. That's a key ingredient for their investment choices. On the political side, we are increasingly focused on political uncertainty, but I think it bears some historical assessment to say we've always had elections and there's been waves of political uncertainty in the past. And so the question is now really worse, or are we just more attuned to it because it's in social media and therefore financial markets react to it to a greater degree than they used to in the past.
Good point. I want to thank you both very much for joining me in this discussion. I think it's been really useful, and your insights have been very, very helpful to our community here at the Bretton Woods Committee. So thank you very much.
Thank you very much.
Thank you, ladies, and I just want to let our audience know that a recording of this virtual conference will be posted on our website tomorrow, www.brettonwoods.org, and you'll also receive a link to the recording and a follow-up email. So thank you, ladies, very much for joining us today. Thank you to all of our audience. And once again, on behalf of the entire Bretton Woods Committee, thank you.
Thank you.
Much appreciated.
Thank you very much.